Welcome back, everybody. Today we're talking about a well-known dividend king, 3M. Now, 3M used to be a poster child for the type of company that investors could just buy and not really think about again. It continued to pay and grow dividends, it continued to see price appreciation, and it's a company with a very diversified business and a wide moat. But 3M stock has gone down over 50% in price over the past 5 years and is buried in multiple sets of lawsuits. But at a dividend yield that's close to 6% in a 64-year history of paying and increasing dividends, is 3M actually a buy right now? Let's find out. All right, if we jump into Seeking Alpha, we see that 3M is currently trading at $100.01. Over the past 12 months, it's down 31.82%, and year to date, it's down 18.34%. And if we actually look at the 5-year, it's down over 51% in terms of price. Now, in terms of dividend yield, it's currently at a 6% yield and a dividend rate of $6 per share. And if we look at the dividend summary, we see their dividend yield and their payout. They have a payout ratio of 65.64%, a 5-year dividend growth rate of 2.65%, and consecutive years of dividend growth at 64 years. And if we take a look at 3M's yield on cost over time, what we see is that their yield on cost is actually going down, which is never really a good thing. What that means is that the price of the shares have been going down to where your yield on cost is actually reducing over time. That's not something anybody really wants. All right, so we look at their profitability tab. We see that their net income margin is actually negative. I'm guessing that's because of the one-time charge that they're taking in Q2. So we'll dig into this one a little bit more. Return on common equity also is negative at this point, which again, I think is due to this one-time charge that they're taking. And then if we at least look at the gross profit margin, we see that it's a little bit over 44%, which in general is positive compared to the sector median, but it's also below their 5-year average. So that's another thing that I'd like to take a closer look at. And if we look at the momentum tab, we can see how 3M has performed against the S&P 500 in terms of total return. If we look at the 5-year, we see that it's underperformed by quite a bit. The 10-year as well. Now you can see right before, 2019, around 2018, 2019, it had still been performing relatively well against the S&P. And then all that changed in 2019 and it's never really recovered. Then if we just look at it for the max number of 30 years. Now, with this downturn that's happened with 3M over the past, 3-4 years, it's basically taken it from a stock that had outperformed the S&P for quite a long time to one that is now severely underperforming the S&P. So that's definitely an interesting turn of events for 3M, especially when you zoom out a little bit and you see how long this downturn has kind of been happening. It's actually pretty crazy. So now that we know what's going on with 3M stock, let's talk a little bit about what's going on in their business. And I think the first question is, what actually is their business? So 3M's a diversified product and technology company that operates in 4 major segments. The first segment is safety and industrial, which includes products ranging from industrial abrasives to masking to packaging materials to structural adhesives and tapes to hearing and eye protection. The next segment is transportation and electronics, which includes things like window tint film and attachment tape for vehicles, graphic films for advertising, and reflective sheeting for road and vehicle safety. The next segment is healthcare, where they provide things like coding software, wound care and infection prevention products, dentistry solutions, and filtration systems. And then lastly, there's a consumer segment, which is filled with the consumer products that you know and probably use from 3M, including bandages, cleaning products, picture hanging, and stationery. So let's take a look at how the business has been performing by diving a little bit deeper into their financials. If we look at revenues over the past 10 years, we see that they've been staying pretty steady and actually growing slowly, pretty consistently, which is not bad. Now, if we look at operating income, it had been relatively steady, but over the last few years, there's been a little bit more volatility there. And part of it is their SG&A expenses have increased. And then in this last quarter, they had a one-time expense charge that they're taking for one of their lawsuits, which is something that we're going to talk about a little bit more here in a minute. Now, if we look at the cash flow tab and we look at cash from operations, you can see that basically up until 2019, their cash from operations was pretty consistent. It was steady and slowly going up, which is a good thing. In 2020, there's a spike here, which I'm guessing is because Companies like 3M that made personal protective gear probably saw a spike in those type of things during the pandemic. But then the last 3 years, the cash from operation has been a lot more volatile than it had been in the past, with it going, up and down quite a bit compared to previous years. And I mentioned before that I wanted to take a closer look at the margins because their current values are skewed by that one-time charge. So let's look at how they look over a longer period of time. So if I go into charting and I select my profitability measures, I'll take net income margin, gross profit margin, and free cash flow margin. Okay, so if we look at this chart, obviously this most recent data point is impacted by that one-time income charge. So that's not really a good relative measure that I want to look at. But if you look at the last 2 years, we can see that their gross profit margin and their free cash flow margin have been decreasing, but net profit margin has been more steady. So what does that actually tell us? Let's talk about the differences between these margins to get a better understanding of what this might mean. So gross profit margin is literally the margin between revenue and cost of goods sold. It should tell you the potential profitability of the company's core products in the current environment that they're in. So things that can impact gross margin are pricing power, as well as the cost to produce or manufacture a product. Net income margin includes other expenses, so this is the percent of revenues that turn to profit for the company. And then free cash flow margin tells you what percent of revenues turns into actual cash flow after accounting for operating expenses and capital expenditures needed to continue running the business. So the fact that 3M's been able to keep their net income margin relatively steady is a good thing, but the fact that their gross profit margin and their free cash flow margin has been decreasing would definitely be a concern. So I would want to understand why that's happening. Because based on this chart, it doesn't look like it's just a one-time thing. Those measures were relatively consistent for about 8-9 years, and then all of a sudden they've been going down dramatically. So why is that? So if we take a look at the financials again, we can see that cost of goods sold, or cost of revenues basically, has been going up as a higher percentage of overall revenues. And if we look at cash flows, we can see that capital expenditures have also been increasing relative to revenues over the past 2 years as well, which is putting pressure on their operating cash flow. So in terms of operating performance, 3M is such a complex and diverse business that it's impossible for me to sit here and look at a few of these financials and understand exactly why things are happening. But what it looks like to me is that it's a company that was extremely stable, that over the past few years has become a little bit less steady and stable than they had been in the past. And obviously part of that instability has to be attributed to the lawsuits that it's currently dealing with. And that's been a huge topic for investors to try to understand, specifically the lawsuits around PFAS contamination, otherwise known as the forever chemicals, as well as combat arms earplugs. Now, I'm not going to rehash all the details of these lawsuits in this video, but we'll talk about some updates and where they're at. In terms of the Forever Chemicals lawsuit, 3M recently reached a $10.3 billion settlement that they agreed to pay over 13 years, which they already included as a pre-tax charge in their Q2 earnings, which is what we've been talking about. But that doesn't necessarily resolve the issue, since the settlement agreement still needs court approval. Plus, there's already a group of 19 states and 3 U.S. territories that have filed a motion to block the settlement. It also doesn't account for all the possible claims or lawsuits for that particular issue, but it is a step in the right direction. Analysts have estimated the total impact of this issue to be anywhere from $15 billion to $25 billion. In terms of the combat arms earplug lawsuit, in June, a federal judge dismissed the bankruptcy filing of 3M unit Aero Technologies, claiming that the Chapter 11 filing was in bad faith. 3M had hoped the bankruptcy filing would help to reach a global settlement for the close to 250,000 lawsuits claiming that their military earplugs were defective and damaged the hearing of military veterans. And 3M has appealed the dismissal by the judge, so the saga continues. So Morningstar is estimating that the combat earplug issue will ultimately cost 3M about $4 billion, but I'm not really sure how we can be confident in that number when 3M's already paid out about $300 million for the 16 trials that have been won by 10 plaintiffs. So if 10 plaintiffs have won over $300 million, what's going to happen to the other 250,000 trials? I don't know. To me, that's a big unknown. Lastly, 3M is planning to spin off their healthcare segment sometime in 2023. While I assume the ability to have more focus and aligned visions for the two companies will be a plus, one of the challenges I see is that it would take away about $1.8 billion in operating income away from 3M, which is already seeing their cash flows being squeezed a bit. Now, I'm not an expert in spin-offs or this type of thing. I'm just looking at the financial statements and how they broke it down by segment and assuming that whole healthcare operating income is going to go away. So obviously 3M has a ton of things going on from a business perspective, but let's take a look at their valuation and see how it stacks up against their current price. Okay, so if we jump into the valuation spreadsheet, we see the data that's been pulled in, return on equity, profit margin, all those things are being impacted by that one-time charge, which we've talked about a bunch. And if you look at the dividend growth rate, you see that over the 10-year, 3M's actually at 9.15, which doesn't seem so bad. But we've already looked at the dividend growth rates for the 5-year and the 3-year, and we know that it's declining pretty rapidly. So anytime that you're going from, a 9% dividend growth rate over the 10-year, but then your 3-year is, less than 1%, that's not great. Now, 3M's dilution trend is down. Their economic moat is wide. And in terms of performance, they have outperformed the S&P at certain points in their timeline, actually for a very long portion of their timeline. But obviously, if you look at them right now, they are woefully underperforming the S&P. So if we take a look at the buy and hold evaluation, if we take cash from operations, we minus CapEx, and we minus stock-based comp, we get a fair value price per share of $110.67. So let's talk through a few of the assumptions that we made with 3M in this model. So in terms of starting cash flow, I decided to use the average free cash flow number. Probably would have been a little bit more conservative to use the trailing 12 months, but there is variability in these numbers throughout the past handful of years. And so usually in those cases, I'll use the average. In terms of starting growth rate, this was a little tough because the calculated growth rate is actually negative. So in these cases, I'll usually go back to Seeking Alpha to try to see what the projected operating cash flow growth rate is. And so in this case, when we look at the growth tab for Seeking Alpha, we see that their operating cash flow growth year over year is 3.66%. Usually I'll try to use the projected cash flow. In this case, our projected cash flow is negative. But if you look at the 5-year average for 3M, it's about 2.87. So in this case, I'm really just kind of splitting the difference and saying, let me just start out with 3. Again, it's just a model, just trying to get an idea of what that projected growth rate might be. So my starting growth rate is 3. My terminal growth rate is 2.5. And my required rate of return is still 12. And I've talked about this a lot as to why I use 12 as my required rate of return. You could argue that 3M is the type of stock and type of company where comparing it to the S&P 500 maybe isn't the right thing. But again, for what my goals are, for the type of companies that I'm looking for, it's basically my required rate of return. So if you do this model for 3M, if you're interested in it, you might have a different number there based on your own goals and what you're trying to accomplish. So now, if we look at the multiples valuation as it relates to price to cash flow, I have a few peers here that I've added: IEP, GE, Hitachi, and Honeywell. And so in this case, Hitachi gives back a error when it comes to price to cash flow, likely because they have negative cash flow. So I'm just going to remove that as a peer. Now, obviously, it reduces the amount of peers that you can compare against, which, you could argue kind of messes up the model. But for now, that's what we're going to do. When you look at this number, it says the fair value price per share is $231.84. You can look at these models however you want. In my personal opinion, 3M is not worth over $230. But this is kind of the limitation of the multiples model, right? Are these the right peers? It's hard to find, I think, a full, complete peer to 3M because of how wide their business is. And so these numbers, in my opinion, aren't all that trustworthy to find a true fair value for what the stock is based on these multiples. So let's go ahead and take a look at the price to earnings. Now, in price to earnings, both 3M and IEP return errors because they have negative earnings. In IEP's case, we'll just remove that like we did for Hitachi on the cash flow. Now, for 3M, the reason why they have negative earnings is because of that one-time charge, which we've been talking about. So what I would do in this case is actually just try to go back to the previous quarter's price to earnings multiple just to see and give me a ballpark of where it might be. So if I go back to Seeking Alpha, I can just real quick go to charting and do valuation. And if I just look at it for the past year, you can see that it was at 10.23. So if I go ahead and just add 10.23 here, what we get as a fair value price per share is $129.83. So again, these multiples models are really just to give you an additional data point. You really have to think through how valuable these are or how close to reality you think they are. Now, in my opinion, the price to earnings one looks a lot closer than the price to free cash flow one, but it is nice just to get another data point to be able to form our overall opinion. So if we go back to the overview, we see that the target analyst mean price is $112.96, which is actually pretty close to our buy and hold calculation in terms of discounted cash flows at 110.67. The multiples valuation, again, the price to free cash flow one I would probably throw out. The price to earnings multiples valuation seems a bit closer to the others, but again, we know the limitations of those numbers. In terms of current price and where it's at, it looks like 3M may be at a point to where it's a little bit undervalued. So when we talk about overall thoughts, that definitely plays into it. But I think, looking at 3M, it's more than just what the valuation is. It's really about how comfortable we feel about the business. 3M has a business that's very important, extremely diversified, very wide moat, and I think they're a company that, regardless of what happens, they're going to continue generating a pretty healthy chunk of revenue consistently for a very long time. But even with all that, their revenues are pretty flat or somewhat declining. Their margins are shrinking. Their cash flow is reducing because of increased costs and increased capital expenditures. And so what they have left over is becoming less and less. And for a company that spends a lot of their operating cash flow paying dividends and growing dividends over 64 years, that's a little bit of a concern. You have the healthcare business, which is spinning off and taking some operating income with it as well. Again, I'm not an expert in how those happen. I'm just assuming that that's what it's going to look like when it's gone. But then in terms of their dividend history, they are a Dividend King, which is normally a pretty good measure of stability. But if you look at the 5-year growth rate, it's just 2.65, and the 3-year is even less than that. And until the lawsuit issues are finalized, I wouldn't expect any meaningful increase in dividends from 3M. And actually, if they come in higher than expected, or if there's some macro change that impacts them and their revenues, you could maybe even see a dividend cut. Generally, for the type of business and moat that 3M has, they're the type of company that I like to invest in. But they just have so much uncertainty around them right now, and the lawsuits represent an uncapped risk. Plus, those declining free cash flows are going to start putting pressure on those dividend payouts. And I think 3M's price showcases that uncertainty that investors have, and it's been a trend that's seen their share price drop 50% over the past 5 years. So even with a dividend yield at 6%, I just can't see investing in them for the long term. I would need to see that turnaround already start to happen, lawsuits get resolved, and that free cash flow start growing again. And normally I would say a company that has relatively stable revenues, a long history of dividend payouts, and a strong yield may be a good candidate for someone who's in retirement or close to retirement. And I just can't see 3M being a really good choice for that right now because, again, there's a lot of question marks around their current dividend and how sustainable it's going to be. And their stock price has done so poorly that anybody putting money into it, even if you're just looking for a stable income, is going to lose so much of your principal that it's just not going to feel worth it. So for those reasons, 3M would definitely not be a buy now for me. There's just too much uncertainty, too many unresolved risks for me to feel confident in terms of long-term growth or even dividend stability. But if they're finally able to get those lawsuits resolved and get that free cash flow growing at a good clip, then I'll be willing to look at it again. But for now, I think there's way better ideas out there. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.